is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs. And we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refunds. Levied on common man's daily use items have gone through a rigorous looking into. And in most cases, the rates have come down drastically.
We ushered in a new era, the era of GST 2.0, the era of very few tax slabs, and more importantly, the era of rationalization. This is the special edition of Markets Forward as India gets ready to usher in the new GST regime. I'm Mangalam Malu, with me Hormaz Fatakia. Hormaz, everything which was 18 and 28 has now been moved to either 18 or 5. All the rates have been curtailed. And the street had cheered that already. A lot of the expectations were built in already. The market ended slightly higher off the highs of the day, but we can't deny the impact of this from a macro standpoint, especially ahead of the festive season. 2 sectors that did well today, consumption and autos. Both of them telling you that this is a mega boost for consumption in the country.
Absolutely. And that has been the story ever since the Prime Minister's address, right, on the 15th of August on Independence Day. And since then, these are the 2 sectors that have been dominating the proceedings when it comes to the markets as well, even though the benchmark index has done precious little. But if you look at the Nifty FMCG index or the Nifty auto index, both of them have seen very healthy gains. And come the 22nd of September, tax rates will be lowered for many daily essentials, small cars, scooters, cement and several other items. And the Dalal Street reacted positively to the new GST regime before profit booking in late trading session. Of course, it was the auto stocks that have been the dominant factor ever since the last 3 weeks, and they hit the highest level in nearly a year. Mahindra & Mahindra hit a record high as well today. The GST cuts on small cars and bikes has lifted sentiment for a lot of these stocks. Sudarshan is here to tell us which companies are set to benefit from this change in the automotive segment.
One sector that has come out as one of the major beneficiaries from GST Council outcome is the auto sector. So what are some of the major takeaways? First, GST rate has been reduced across the segment. Second, compensation cess or say GST cess goes away. Third, effective rate for even 40% slab would be lower than the earlier tax rate. Fourth, small cars, most selling bikes and auto parts will now fall in 18% slab versus earlier tax rate of 28%. Fifth, tractor and its parts will now fall in 5% slab. And sixth, EVs will remain in 5% slab. So which all companies would benefit the most? So first talk about small cars. So companies that would benefit the most are Maruti, followed by Hyundai and Tata Motors. Second, for bikes up to 350cc, the biggest beneficiary would be Eicher Motors, followed by Hero MotoCorp. Why would Eicher benefit the most? Because almost 90% of its total domestic volumes have bike with capacity of up to 350cc, exactly 349cc. Only 10% of its domestic volumes fall in the capacity that have more than 350cc, for which tax rate is increased to 40%. So it's a minor negative, but overall it's positive for Eicher Motors. Next is tractor. Biggest beneficiary would be M&M and Scott's Kubota. Apart from tractor, M&M would also benefit from SUV. Despite its best-selling SUV, that is XUV700, is being moved to 40% slab because effective tax rate will now be 40% versus earlier effective tax rate of in the range of 43 to 50%. Next is three-wheelers. So biggest beneficiary would be Bajaj Auto and TVS Motor. Next is tires. So Apollo Tires, MRF, Seat and Balkrishna Industries. Balkrishna Industries will also benefit because it's the supplier in the tractor segment, and tractor tires will fall in 5% slab. And last is auto parts, and biggest beneficiary would be Endurance Technology, Bellrise Industries, Sona BLW, Motherson and Carraro. So now after the GST Council outcome, the hope would be that if industry sees an increased demand and if we see an increased estimates for FY26 from current estimate of single-digit growth.
So Darshan, thanks a lot for that. From autos, let's talk about the consumption space. It's been very clear from the finance minister's statement that they want to boost consumption. On the one hand, you had the income tax cuts that came by in the budget, thereafter the RBI cutting interest rates as well, and now the GST rationalization specifically on daily use items like soaps, shampoos, hair oil, toothpaste, toothbrushes, biscuits, etc. All of them down to about 5%. And for a lot of the dairy products, the 5% slab has been moved lower to about 0%, and a lot of the paneer products, etc., moving down from 12% to 5% as well is a big positive, which is why we saw that big gain come by in the likes of HUL, Colgate, Britannia and the likes. The only stock which ended lower was Varun Beverages, and that too because it was expected that something like an aerated beverages, etc., would go all the way up to 40% from 28%. Does that mean your cola gets expensive? No. It only means that earlier it was 28% plus cess, but now that cess has been subsumed, all you have to pay is 40%, which is pretty much in line with what these companies were paying already. Bikaji, for instance, had namkeen, bhujiyas, etc. Nearly 90% of their overall portfolio now stands at 5% taxes, and they said they would see increased volumes to the tune of 3 to 5% on account of this rate rationalization. Does this also mean that you have to scamper for change every time a 5 rupee product has become 4 rupees 50 paise? No, that's not the case. India is a price point market. What these companies will go ahead and do is keep the price points at 5, 10, 15, 25 itself, but give you a little more bang for your buck. So you will get more grammage for the products that you buy at the price points that you buy, which also means it is volume positive for a lot of these FMCG companies. So all things said and done, this is a massive boost to all things consumption, and that's something that we've seen in the stock prices as well. Yes, there was some bit of profit booking today, but that's ahead of all the up move that we've seen after the Prime Minister's speech on the 15th of August. So it is 2 thumbs up to consumption, and the stock market reacted accordingly.
2 thumbs up indeed, and 2 thumbs up also in hopes that the wafer packet will now have more wafers in anticipation of what we pay for at the end of the day. Mangalam, thank you for that update from the FMCG space. The other one that was in focus, of course, was the textile and the apparel industry that will also benefit, as key inputs and finished products will now fall under the 5% tax slab. And Vinny is now here to take us through the impact of this move on a lot of these textile companies.
Thanks so much for that. So yes, surely a GST boost that is coming in for the textile and apparel players, because previously these players had multiple rates, right? There was 5%, 12%, 18%, 28%. Now it's coming to 2 unified rates of 5% as well as the other rate of 12% is what we'll keep an eye out on. What does this mean? Rate reductions will lead to lower procurement prices for textile players, especially in terms of key inputs. Now, inputs, whether you look at in terms of the value chain of yarn, whether you look at in terms of the threads that are made as well, all these will see a reduction. Man-made yarn, 12% to 5%. There was man-made fiber, that is from 18%, it's coming down to 5%. A unified rate now of 5% for most of these input products, which is positive for them as well. Now, other than that, finished products also are seeing a cut, right? 12% to now 5% is what's coming at. Bath linens are the products, carpets, rugs, all these finished products from textile players actually come into the 5% range now. Let's talk about apparels. Apparels, now we're saying that GST of 5% will be on apparel products not exceeding 2,500 rupees per unit. Previously, this 2,500 rupees was 1,000 rupees. So an increase in terms of that rate, that is what is coming in, right? So 1,000, now it's moved to 2,500 rupees, and a lot of companies will benefit from this as well. Some of the beneficiaries from these changes will be Welspun Living, Indocount Industries, KPR Mills. Other than that, we also have Gokul Das Exports, Vardhaman Textiles, as well as Nitin Spinners among some of these gainers. And obviously, these unified rates is something that will give a boost in terms of the demand for the companies as well.
All right, and that's not all, Vinny. In fact, we also had a shot in the arm for consumer durables. All the large screen TVs will now be charged at a much lower rate than earlier. And in fact, a lot of the other white goods as well, the likes of dishwashers, etc., would become cheaper. For that list, we have Upasna joining in. Upasna.
Big consumption boost announced by the government with the onset of festive season. Let us look at the key categories that will be in focus on the back of GST rate rationalization. Now, categories like ACs, large TV, dishwashers, here GST has been reduced to 18% from 28%. While on solar water heater, the GST is reduced to 5% from 12%. Now, lower GST directly stimulates demand for ACs and large TVs, expanding the market size for domestic production. Now, Elara Capital believes that on AC, RAC demand may rise minimum by 10 to 15% on the back of this. And it feels that the RAC OEMs like PG Electroplast, Ember Enterprises, EPAC Durable may see a spurt in volumes in the H2 FY26 onwards. On TV, the brokerage believes there is no direct beneficiary, but Dixon Tech assembles TVs for numerous brands in India and may see volume growth in H2 FY26. On solar water heater, the brokerage believes it is a growing market in India and key beneficiary here would be V-Guard and Havells. Coming to dishwashers, it is still a nascent category with an estimated market size of 700 crores. And the key beneficiaries here would be Voltas Beko and IFB Industries. Now, Blue Star believes that company was initially expecting a 15 to 20% growth this festive season, but on the back of this, it now expects a 30% growth thanks to GST rate rationalization. So overall, it's a positive move for consumer durable sector.
Upasana, thank you for that comprehensive wrap for the consumer durables space. The other major pocket that made headlines all through the day was insurance, and that is the individual health and life insurance is now exempt from GST. But the industry fears that the costs will rise without benefits under the inverted duty structure and the input tax credit. Yash is here with all of those details. Yash, over to you.
Well, Hormaz, let me just take you through the key headlines. As you said, GST exempted when it comes to both life insurance as well as health insurance. And as far as the reinsurance, which goes behind life and health insurance. Which categories under life insurance will see the exemption of GST? This would be term life insurance products, annuity products, ULIP policies as well as endowment policies. Which categories under health insurance? These would include your general health insurance as well as family floater. Now, two important caveats which came and which we have been reporting for quite some time now. First, there will be no benefits of ITC or input tax credit on when the GST moves to exempt categories. Second thing, there won't be any benefits of inverted duty structure which insurance companies will be able to derive once the GST goes into exempt category. Now, what does it mean for policyholders? Well, certainly benefits will come for policyholders in terms of lower premiums in a situation where insurance companies pass on the entire benefit. For health insurance policies, the premiums could come down by 18%, which would be the cut from 18% to exempt category. For life insurance, two categories, ULIP as well as term life insurance, the benefits could be to the extent of 18% for policyholders. For endowment and single premium annuity policy, the benefits could be of about 4.5% to 1.8% because that's the current rate of GST on these policies. What does it mean for insurance companies? Well, the cost for insurance companies is expected to rise. First one, the reason being that there is no input tax credit available, which means on a 100 rupees premium, if 70 rupees was the cost, the insurance companies could offset that cost by taking input tax credit, which now won't be available to them. The second reason, no benefits of inverted duty structure. Well, commission costs, claim costs, the inverted duty structure hasn't been corrected, which means that cost will come onto the books of insurance companies. Well, we've been speaking to analysts and working out numbers ourselves. The cost of health insurance policy for the insurance company could go up by 5 to 7%. For life insurance, that cost could go up by 9 to 11%. There are three scenarios finally which come out of it. First thing, the insurance companies could take this cost on themselves. The VNB could get impacted negatively. Loss ratios could increase. The second scenario is that they could share this cost with the distributor like Policy Bazaar because commission is not under the inverted duty structure or exemption category. Finally, they could partially pass on the benefits to policyholders and keep some to themselves. These are three scenarios that we're looking at, but certainly a big positive for policyholders as premiums expected to come down, not so much for insurance companies as the cost would go up.
Right, take that point, Yash. Thank you so much for that. With that, we'll take a short break. Now that we've told you all that needs to be known about the GST rate rationalization as a consumer and as a viewer, but importantly as an investor, how would this impact the markets? How should this impact your portfolios? What investment decisions you should make basis the announcements that have come by? Shreyas Devalkar, who's the head of equity at Axis Mutual Funds, joins in after this short break. Stay with us.
Still with us here on Markets Forward. As promised, Shreyas Devalkar of Axis Mutual Fund is now joining in. Shreyas, thank you for sparing time and joining us today. You heard the gamut of announcements that were made by the GST Council. You also heard our colleagues break it down for our viewers as well. Now, within this entire GST basket, be it FMCG, consumer durables, automobiles, insurance, where does your preference lie, and where do you think that investors should park their money or put money to work as of now? Because a lot of these moves were already priced in for a lot of these sectors over the last couple of weeks.
So, first of all, we should look at this development as a holistically. What it does is simplification of tax structure. It actually has, in the process, it has reduced tax on most of the items, and especially the items which are going to 5% category. Now, if you start looking at if there is a 5% GST and if there are sectors, companies where there is a competition from unorganized sector, and now suddenly versus that, now you're at 5% GST versus a 12% GST. So there are multiple such benefits wherein this kind of GST structure is going to benefit both because of simplification, both because of market share gain to some of these sub-segments. Now, coming to which category, per se, obviously, you have highlighted in your analysis the beneficiaries, which are obviously there in the automobile, then they are in the consumer durable, they are there in consumer staples as well. So the beneficiaries are going to be there everywhere. But point is that since it is going to be passed on, and one need to look at that where there will be the elasticity of demand. Such to give example, there is an insurance as well. But now whether there will be elasticity of demand in there, that one need to really check. Because some of the products are push products, some of the products are not. So there is more likelihood that elasticity of demand especially may come in the discretionary items more. Because in the staples category, some of these categories are highly penetrated. So it may or may not result in higher elasticity of demand based on the volume growth. While in case of consumer discretionary, yes, that has observed, historically it has been observed that there is some role it has to play. The pricing has some role to play in that. So I would look at from all these perspectives. So one is market share gain for organized. Second is elasticity of demand, where it is actually playing.
Right, so elasticity of demand is very high in some of the low-ticket consumption items, and that's something that we saw in a couple of these stocks that did well today as well, the likes of Colgate, Britannia, etc. But mind you, these were stocks that were beaten down post their first quarter numbers as well. So it's not that they had already been doing well. Fundamentally, the performance was fairly weak for Britannia as well. Case in point, the volume growth was just about 2.5%. Do you believe that this rate rationalization holds the key for their volume increase from here on? Yes, margins will not improve because all the benefits will be passed on. But because it's so price sensitive, it may be volume positive. So to that extent, would you bet on any of these staples names because of what has been announced?
So it doesn't, your question actually doesn't get restricted to these. So if you look at even the auto growth was low. It was not that auto growth was high. Even cement growth has been subdued for some time. So whether this cut per se, and now if you look at the holistically the number and the kind of stimulus we are talking about, broadly from the central point of view, it is a 50,000 crore stimulus, including says it is additional 1 lakh crore. Then per se, this is this need not be the only reason to believe that there is going to be a sudden uptick in demand. So I think similar question came when there was a tax rate cut as well, and that was somewhere around 1 lakh crore demand boost, which actually government gave during the budget time. So one should look at this cumulatively and it impact panning out over next few quarters. So cumulatively, in the sense, there is a tax rate cut, there has been easy liquidity. Now there is this additional 1.5 lakh crore of additional stimulus, and this cumulative impact of this, along with the base effect of actually we have seen subdued growth for some time in some of this category. This combined impact, and then there is obviously the good monsoon which we are seeing now. This combined impact one should look at, and it's that impact may come in 1-2 quarter down the line. That's how I would look at it, rather than only because of the GST.
Well, one such sector also about the elasticity of demand has been cement as well. You read a couple of brokerage notes that were mentioning about this. But for a sector like cement that hasn't done much over the last, say, year and a half or so, and now you are heading into the festive season where possibly there are hopes of demand picking up now that the monsoons will also head to an end. Does this GST rate cut also further add to the demand boost that is anticipated, thereby boosting volumes and then thereby boosting the financials of a lot of these companies?
The cement sector companies, actually, most of the companies' financials are good in this cycle so far. Most of them, obviously. In the context of the demand boost, actually, the cement demand is not too much dependent on the prices per se. So this GST rate cut in itself may not lead to cement growth as such, because cement is just one of the component of end product, whether it is a house or it is any infrastructure project. So here the demand, to expect that the demand will go up, volume growth may increase just because of this, is not the right expectations to have.
All right. And what do you make of the markets in general? Because, even as we are bombarded with good news after good news for our equity markets, be it, record SIP flows, be it something like the GDP data that came in, even the auto sales weren't particularly bad. There is the festive season ahead, and now there is the GST rationalization that has come in as a booster shot for consumption. The market's struggling at higher levels. In fact, even today it ended off the highs. So what are your thoughts on the market positioning right now? We've been underperforming the globe. So what explains this, and what do you think could change the triggers for us?
So one key factor here is definitely valuations that we should not ignore. The fact, see, we are sitting on a 3-year rolling return in mid and small cap of 23-25%. So in the large cap also, these rolling returns are high. So if not as high as 23, here the returns are somewhere around 15-16% or 17-18% odd in the large cap. I'm talking about 3-year rolling return. So when you're sitting on that kind of return, especially in the mid and small, and that's where you're seeing the mid and small is not moving much. So first of all, as when it comes to the consumption stories representation is more in the large cap. It is upwards of 70%, while consumption stories representation is less in the mid cap. It is around 50-55%. So, and that's where that impact you are not seeing commensurately in these two indices. Secondly, when we are looking at the valuations and very high gains what we had, definitely, even after some of these corrections which we have seen, the valuations are reasonable, but they may not be attractive. And thirdly, on the flows front, especially if you have seen that the flows from the domestic is definitely good, but FIS flows has had some challenges for some time. And that actually is also impacting the market returns. If you see, there have actually in last 1 year, some of the emerging markets have done much better, especially because of the flows and various developments in those markets, particularly. So these are the multiple reasons why the returns you are not seeing commensurate to the announcements.
All right, Shreyas, thank you so much for joining in. All things that we need to watch out for now is earnings pickup and perhaps some moderation in valuations, time correction, maybe if not price correction that we're seeing right now. But thank you so much for joining in with your views. With that, we'll wrap up on this edition of Markets Forward. Stay tuned to CNBC-TV18. We'll be back with more news and updates on the other side. A lot of commentary coming in on all things GST and from regulators, along with big voices in the markets, along with the big voices in Delhi.